We'll continue our discussion on dividend discount model. In the previous video, we were solving for multi-stage. In this example, we saw that instead of having one growth throughout, we will initially have a supernormal growth, and then growth will gradually decline, and eventually it will settle with a long-term rate. The long-term or sustainable growth also links with the economic growth of the company. The company cannot grow more the economy till perpetuity. The example is, company is growing at 10% for 3 years, it settles with 6% later on for another 3 years, and then 3% finally in perpetuity. In this example which we are solving, we applied the supernormal growth of 25% for next 3 years. We arrived at the 4th year dividend expectation. So now what we need to do is really calculate the present value of all the future years to the 4th year. So from 4th year onward, we need to apply Gordon growth model, which is basically values equal to dividend divided by R minus G. The growth is 5% and cost is 10%. So we have 10 minus 5%, that is 5%. Here we have is 4.1 divided by 10 minus 5%. We get $82. Next, look at the cash flows and then calculate the present value of cash flows. Apply the formula to discount all these future cash flows in the form of dividend and this 82 as the price and then add. So, the formula is the cash divided by 1 plus R raised to the power of that year. So, divided by 1 plus 10%, which is our cost. This is 1 year, hence we are raising it by 1. For next year it will be 2, and then 3. So here we see that it is 1/1 plus 10% raised to the power 2. And in this it is 1/1 plus 10% raised to the power 3. These are present values of year 1, 2, and so on. So, when we sum these all present values, it will give us the total value, which is nothing but the stock price.